Hey everybody, today we are going to talk about SoFi earnings. The stock dropped pretty sharply after the report came out. So we're going to get into the numbers. Before we do, please take a minute and check out the link you see on your screen, fool.com/Frankel. You can get the top 10 stocks to buy right now from my sponsor, The Motley Fool. It's the best way to support this work I'm doing on YouTube. Again, that is fool.com/Frankel. So let's get right into the numbers. So SoFi stock is down about 15% since the earnings came out. I'm recording this 2 days after the earnings report. And to be fair, there are some reasons for it. A lot of people say that I'm always bullish on SoFi no matter what happens. And that's half true. I love the management team. I love the business. I love what they're going to do long term. But as far as quarter by quarter, sometimes the quarters aren't as great, and this was one of them. All right, so let's start with some of these numbers. So just starting with this first page, SoFi added 622,000 new members in the first quarter. They are still adding a lot of new members. That's more than they added in the fourth quarter. And it is a 44% year over year growth rate. So far, so good. Products. A product would be something like getting a credit card, opening a brokerage account, things like that. SoFi added nearly 1 million products in the first quarter alone. That again is more than they added in the fourth quarter. If you look at the year-over-year growth rate, it is decelerating. It went from 45% in the third quarter to 41% in the fourth to 38% now. So a little bit of deceleration there. Nothing really to worry about. One key thing you want to watch is that they are adding new products at a faster pace than they're adding new members. Considerably faster in this case, about 1 million new products, a little over 600,000 new members. So far, pretty decent numbers right there. The Galileo fintech platform grew 20% year over year to 151 accounts under its platform. That is a nice acceleration. The last time they had a growth rate in the Galileo platform of over 20% was at the end of 2022. So that is growing nicely. You can see financial services products are dominating the numbers right here. But again, a little bit of a deceleration for the past 3 quarters right here. So that could be kind of weighing on the stock. Same in loans. SoFi is admittedly getting kind of cautious when it comes to making new loans. Their credit standards have risen significantly in recent quarters. A lot of macroeconomic uncertainty, rising interest rates make loans a little more risky inherently because they're harder for people to pay back when interest rates are so high. So that's to be expected. The financial services products could be a slight disappointment. And another kind of thing I wanted to mention before we move on, SoFi is what they call the financial services productivity loop. Essentially, this means that the more financial products they sell, meaning the more checking accounts people sign up for, the more investment accounts, the more credit cards, the easier it is to market their money making products, meaning loans, to qualified customers. So right now there are 5.9, almost 6 financial products for every one loan on their balance sheet. So that's a nice ratio. You can see that's up from about 4 to 1 2 years ago. And the bigger that gets, the theory is the less they'll have to spend on marketing and customer acquisition, which is, if I'm being totally honest, a pretty big cost problem now for them. SoFi offers some of the best new account sign-up bonuses in the industry when it comes to checking and savings accounts, investment accounts. So the more they can grow that and get their cost structure down, the better. So let me unshare my screen right now. A couple of other things I wanted to mention. One, SoFi's deposit base is up significantly. That grew 16% year over year to $21.6 billion. That is pretty impressive considering that SoFi started from zero at the start of 2022 when it became a bank. SoFi wasn't always a bank. They were a student loan company. They used third-party banks to offer financial products to their customers. Not anymore. Now they are a bank. They have their own deposit base. And now their deposit base is getting very close to what their loan portfolio is. They have 21.6 billion in deposits, 23.2 billion in loans. The more of that loan portfolio they can cover with deposits, the better their cost structure is going to get. It costs, in simple terms, it costs more to borrow money to fund your business than it does to just take in deposits and fund loans that way. So it's approaching 100%. It's not quite there yet. I'd love to see it get a little bit over 100%, and so would a lot of other investors. But if it keeps growing at the rate it has been, that will happen before too long. So why did the stock react so poorly? So far, everything I've mentioned sounded pretty good, right? So for one thing, I already mentioned that kind of sequential revenue decline, in revenue growth decline that we saw in the quarter. Uh, okay, so if you look at this chart, you'll see that not only did revenue growth decline year over year in the fourth quarter, it went from 34% year over year in the fourth quarter to 26% in the first quarter. But net revenue itself actually declined a little bit year or sequentially. It's the first time you saw that chart go down. Quarterly adjusted EBITDA. Now, to be fair, the fourth quarter of 2023 was exceptionally strong, but we did see adjusted EBITDA kind of pull back a little bit. So those two things could be weighing on the stock a little bit. We're seeing asset growth kind of slow. That's by design. SoFi's taking a cautious approach to lending right now. So it makes sense that their assets are growing slowly, but they disappointed the market with weak guidance. And anyone who's been following the stock market for longer than a couple months can tell you that there is no more surefire way to make a stock go down than to disappoint with your forward outlook. It almost matters. It matters a lot more actually in some cases than what you did this quarter, what you say you're going to do in the next quarter. Analysts had been expecting about 580 million in revenue in the second quarter. SoFi said it's going to produce 555 to 565 million in revenue in the second quarter, so significantly lower than expected. It reiterated its guidance for full year lending revenue that's about 92 to 95% of 2023 levels. Investors were kind of hoping it would be a little better than that. And the bank is projecting that its adjusted EBITDA margin will be about 25% at the end of the year. That was down from 30% in the fourth quarter of 2023. So on the bottom line, they actually raised their earnings guidance just a little bit, now calling for 8 to 9 cents of full year earnings per share and a slight raise. So looking ahead, I actually think SoFi is suffering because of low interest rates right now, or high interest rates right now, and could be one of the biggest beneficiaries if interest rates fall. For one, they've been building this deposit platform while interest rates are high. It's a great way to attract new deposits, but it also is a benefit when interest rates start to fall. That deposit base becomes a lot cheaper. Meanwhile, the loans that are on the books still pay the same amount of money. It takes a while for low interest rates to work into the loan book, but with deposits, it's relatively instant when they lower interest rates. This could be a big benefit for SoFi's home loan business. A lot of people don't realize they're a mortgage lender. Their mortgage volume more than tripled in the first quarter. It still makes up like 1/10 of their personal loan volume, so a pretty small piece of the business. But we could see a lot more interest in the quarters ahead if we actually see interest rates start to fall. Generally speaking, SoFi would be just a big beneficiary of lower interest rates. And another thing, they did successfully increase their tangible book value. That's what a lot of people are saying. Why is the stock down? Their tangible book value is up significantly quarter over quarter. And the answer to that is yes, but this is still an expensive bank stock. Investors need to know and acknowledge that. Let me share just a chart with you real quick. This is a chart of SoFi's price to tangible book multiple compared to other banks. So what this means, right here, SoFi is trading at roughly, even after this drop, about double its tangible book value. Now, it gets away with that because it's growing fast. You're growing your membership base at 44% year over year. You could trade at a premium. But if you look at some of these other banks, Bank of America trades at about 1.5 times tangible book. And comparing to some other online banks, Axos Financial is a big online bank that's in the same size category as SoFi, about 1.5 times book value or tangible book value. Ally Financial, which is arguably one of the more successful online banks, they have a deposit base much larger than SoFi's, transferred just over 1 times its tangible book value. So SoFi still trades at a pretty big premium, even after this recent drop. So a lot of times when you see stocks trading for such a big premium, it makes them a little more sensitive than most to when things are not up to expectations. So the quarterly guidance not being what investors wanted for a company that not only trades at a premium, but has a strong history of beating their aggressive expectations, um, could be a bit of a red flag. Again, I love what SoFi is doing long term. I think when interest rates come down, it will be a big beneficiary, and I think the market is kind of underestimating that. But for the time being, it's totally understandable why there's a negative reaction to this quarter. SoFi has been just blowing expectations out of the water for several quarters. And for it not to do it this quarter, it's not surprising for the market to react like that. Let me know your thoughts. I want to know what you think about SoFi's quarter and the stock in general and looking into the future. Are you a shareholder? Are you not? Hopefully you enjoyed this. Again, take a look at fool.com/Frankel, and thanks for listening. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.